Hi there, welcome back to the three-part series on private placement investing with a self-directed IRA, self-directed 401k, self-directed Roth IRA, or other tax-advantaged investment account. In video one, we talked about how it's never been easier to invest in private placement investments with a self-directed IRA, leveraging the technology, the tools, the resources, and the education offered here at Equity Trust. In video two, we talked about how to actually direct your funds for your investment and manage your investment, the documentation required, and how to move funds from point A to point B. And then in this video, we're going to talk about the rules and the guidelines associated with using your self-directed IRA to invest in private placement offerings. So let's jump in. First, it's important to understand that when you're using your self-directed IRA, if you are investing in a transaction that's considered disallowed, your IRA can be invalidated. In other words, your IRA could be distributed in the year in which you engage in a disallowed transaction. These are referred to as prohibited transactions. So you're going to want to write that down, prohibited transaction. If your IRA engages in a prohibited transaction, your IRA becomes distributed January 1 in the year in which that transaction occurred. And you'd have taxes, penalties, there could be an accuracy related penalty imposed. And so we want to make sure we provide information and education so that you can make an informed decision. Now, if your IRA is simply investing in a fund, an LLC, an LP, an INC, whatever the case may be, and you personally nor any family members have any involvement in the company whatsoever as an employee, officer, director, on the board of advisors, they're not involved at all. It's just simply your IRA making a passive investment. You should be absolutely fine. It's when your IRA is investing in a fund, hedge fund, venture capital fund, private equity fund, whatever you may call it. It's when your IRA is investing in an entity that you personally or another disqualified person is involved in as an employee, an officer, a director on the board of directors, even consultant. It's when that individual is involved in some capacity that it could be potentially a prohibited transaction. Now you're going to learn there are areas of gray. So there are transactions that are blatantly prohibited. There are transactions that appear to be absolutely acceptable. And then there are transactions that are gray. And so we'll talk through that in this session. So first, what you have to understand prohibited transactions is who are disqualified persons to your IRA. So under Internal Revenue Code 4975, there are what are called disqualified persons to your IRA. Disqualified persons to your IRA would include you to your IRA. You're the, think, number one disqualified person to your IRA. Your spouse is a disqualified person to your IRA. And then anyone up and down the family tree. So you have your children, you have your grandchildren, you have your parents, and you have your grandparents. These are considered disqualified persons to your IRA. Just remember, anyone up and down the family tree. Now, interestingly, brothers, sisters, cousins, uncles, nieces, nephews, people across the family tree are not considered disqualified persons. So technically speaking, you could transact with a brother or sister using your IRA funds. And then over here, we have any LLC, corporation, LP, any entity, let's just call it an entity, that is owned 50% or greater by the above mentioned disqualified persons. So for example, the LLC that you are a 50% owner of is a disqualified person, which means your IRA cannot invest into that company. Your IRA can't make a loan to that company. If that LLC is going to issue a round of debt, your IRA can't buy a convertible note. Your IRA can't buy a safe agreement. Why? Because the entity is a disqualified person. And that entity cannot transact with your IRA. A transaction would be buying, selling, leasing, could be lending money, could be furnishing of goods, services, and facilities. And it can also be what's referred to as the transfer to or use by or for the benefit of a disqualified person of the income or assets of the plan. That's directly from 4975 of the Internal Revenue Code. And that would be the personal benefit rule, which we're going to examine in just a second here. So know who disqualified persons are to your IRA, and know that if your IRA transacts with a disqualified person, that it's a prohibited transaction. And if you engage in a prohibited transaction, then the IRA becomes distributed January 1 in the year in which that transaction occurred, which means you'll have taxes. If you're under 59 and a half, a 10% premature withdrawal penalty. And then there could also be other penalties associated with that transaction, given the particular circumstances. So now that you understand that, let's move on to what's it would be considered a very simple transaction that would have very little risk of a prohibited transaction occurring. Well, let's say your IRA is investing in a private placement. And let's say that that private placement is let's just call it real estate syndication, okay, an apartment building. So the sponsor, the LLC, is buying an apartment building and they're bringing in a bunch of investors. And let's say you want to use your IRA to invest in that company. And we're going to make the assumption that you aren't part of the management team. You weren't the one that found the investment. You just simply were approached by a company that was offering you the ability to use your IRA to invest in that particular LLC. In that instance, there's no disqualified persons, let's assume, involved in the LLC. You're not a manager, officer, director on the board of advisors or board of directors. It's just simply your IRA passively investing. In that instance, you should be okay because there's no disqualified person involved. It's just simply your IRA making an investment in that company. All right, so now let's change the narrative a little bit here. And let's make the assumption, just for the case of explanatory purposes, that you are a manager, okay, or an officer of an LLC. We're going to say a manager if we're talking an LLC. And let's make the assumption that you are a 50% owner of an LLC, and then you have an investor partner that's the other 50% owner. And then this LLC is going to form an LLC down here. And this LLC down here is going to be owned by, let's say, many investors. And so you're going to go out and raise capital through this LLC because you're going to go out and do maybe a special project. Maybe it's an apartment building or other commercial real estate, or maybe it's just a private equity fund. And that private equity fund is going to go out and invest in lots of other companies. But you're going to bring out a bunch of equity partners. And so many investors look at a transaction like this and they say, okay, well, me personally, as the disqualified person, let's say in this example, I have well under a 50% ownership interest in this LLC, and it's only going to be my IRA that invests in the company. So rewind for just a moment. This LLC is going to be formed, and there's going to be lots of equity partners. And I, John Bowens, am not personally invested in this LLC. It's just the management LLC up here that I own 50% of that is managing this LLC. And then we bring in all the equity partners. So the argument that many folks make here is they say, okay, well, my IRA is investing in an LLC, and that LLC is not a disqualified person because I personally don't have any involvement, nor are there any other disqualified persons involved. Well, that might be an okay argument. However, this falls into the gray area because the argument could be made that the IRA money is rolling up to this LLC that I own 50% of personally. And so I'm personally benefiting from the transaction in the here and now. There could also be an argument that I personally am providing a service to the IRA under 4975, goods, services, and facilities. So administratively, a custodian might be able to process an investment like this and custody it. But just because a custodian will process a transaction doesn't mean that it's bulletproof. This particular transaction in this scenario could be challenged in an IRS audit, and ultimately the IRS could determine it to be a prohibited transaction under the argument that the IRA is providing a benefit. And that would be under the transfer to or use by or for the benefit of a disqualified person of the income or assets of the plan. All right, so that's one scenario. Another scenario I'll see quite often, let's get rid of this here. Another scenario I see often is where an investor will be a member of an LLC or corporation or LP, doesn't really make a difference. and they'll have, let's say, a 20% interest. The interest is really arbitrary. It's under 50%. Okay, so they have under 50% interest, and they say, okay, because I'm under 50%, that means that my IRA can transact with the entity. That should be okay. In fact, some investors will actually try to use their IRA money and make a loan to the LLC. So they'll say, okay, well, I'm not going to structure it as equity because then I might go from 20% to a significantly larger percentage. So instead, I'll use my IRA money and loan money to the LLC. And because the LLC is not a disqualified person, it shouldn't be a prohibited transaction. Well, there was actually a tax court case on this, the Rollins case, Joseph Rollins. And in the Rollins case, this taxpayer had between about a 9% to 22% interest in 3 different companies. And he used his IRA to make a loan to all 3 companies under the pretenses that the entity wasn't a disqualified person. And ultimately, in this tax court case, the IRS argued that, well, no, you derived a personal benefit. And under the transfer to or use by or for the benefit of provision of 4975, it's a prohibited transaction. So remember, these gray area type transactions that we're referring to, a custodian, generally speaking, is not going to be able to tell you whether it's okay or not. They may be able to administratively process it, but just because they're administratively processing it does not necessarily mean it's absolutely permitted and absolutely bulletproof. That being said, if you're going to get very creative in structuring IRA transactions where you have some kind of personal involvement in it, it doesn't mean that it's prohibited. It just means it falls in the gray area. And so that's where you're going to want to make sure you talk to a qualified CPA, a qualified attorney, someone that can help you structure that transaction so that you can gain a little bit better comfortability around using the IRA for that particular transaction. So I hope you enjoyed this segment on rules and guidelines associated with self-directed IRA investments in private placements. I hope that the examples made sense to you. Certainly, we're here at Equity Trust to answer your questions. Although we can't provide tax, legal, or financial advice, you can certainly bounce some of these ideas off of us depending on your individual situation. And we can help walk you through this and provide some additional information and education. And of course, we would encourage you to team up with your CPA and or attorney to talk through the nuances of your particular transactions. I hope you enjoyed this 3-part video series, all on private placement investing. Until the next program, keep leveraging compounding interest in the absence of taxation.